The room was quiet except for the sound of pages turning slowly under the dim yellow light. Outside the city moved with urgency, but inside this small office time seemed to stretch and soften. Benjamin Graham sat alone at his desk long after the markets had closed. The day's prices no longer mattered. What mattered was what remained when the noise faded. He had learned long ago that markets shout but value whispers. Those who learn to listen survive. Those who demand certainty rarely do. Earlier that morning a young investor had visited him. The man spoke quickly. His voice carried excitement and fear tangled together. He talked about opportunities everyone was chasing. About prices rising without reason. About missing out. Graham listened without interruption. He had heard the same words decades earlier spoken by different mouths during different cycles. Each generation believed its moment was unique. Each believed the rules had changed. Each would later discover the rules had only waited patiently. After the young man left, Graham returned to his desk and opened a worn notebook filled with observations accumulated over years of market booms and collapses. He did not record predictions. He recorded behavior. He understood that numbers change, but people rarely do. The same emotions repeat. Hope expands. Fear contracts. Confidence grows careless. Panic becomes contagious. Markets do not move because information appears. They move because perception shifts. And perception shifts faster than truth. Graham remembered his early years when speculation felt harmless. When optimism seemed justified. When leverage was praised as intelligence. He remembered how quickly admiration turned to disbelief and disbelief turned to ruin. He remembered investors who believed themselves rational, discovering too late that emotion had quietly rewritten their calculations. He did not judge them. He understood them. Markets reveal character before they reward intellect. One evening during a previous crash he had walked through the streets watching people stare into newspapers as if the ink itself carried blame. Fortunes had vanished. Yet businesses still existed. Factories still produced. People still needed goods and services. The disconnect fascinated him. Prices had collapsed faster than reality. It was then he realized that the market was not a weighing machine in the short term, but a voting machine. Votes fluctuate wildly. Weight remains. Years later, this insight shaped how he approached every decision. He imagined the market as a business partner who appeared each day offering to buy or sell ownership at emotional prices. Some days the partner was euphoric. Other days depressed. Graham did not argue with him. He listened. He acted only when the offers became unreasonable. He understood that patience was not inactivity. It was selective participation. As the decades passed, Graham noticed a pattern. Investors who focused on stories suffered more than those who focused on statement. Narratives changed weekly. Balance sheets changed slowly. The crowd chased momentum while quietly abandoning margin of safety. Margin of safety was not excitement. It was survival disguised as boredom. Few respected it until it was gone. One winter afternoon Graham visited a small manufacturing company few investors cared about. The building was unremarkable. The workers moved with quiet routine. The business would never appear on magazine covers. But its books told a different story. Cash exceeded debt. Assets were priced below replacement cost. Earnings were steady though unspectacular. This was not a story worth telling at dinner parties. It was a story worth owning. When markets later fell and fear swept through portfolios, this company endured. Its stock declined with everything else, but its value remained intact. When prices recovered, those who had dismissed it as dull discovered it had quietly compounded while they chased excitement elsewhere. Graham took no satisfaction in being right. He took satisfaction in being prepared. Preparation became his central theme. He understood that intelligence without discipline collapses under pressure. He saw brilliant minds ruined by leverage and simple minds preserved by caution. Markets do not select for genius. They select for resilience. Those who remain solvent long enough allow time to do its work. Graham often reflected on how investors misunderstood risk. They equated volatility with danger and stability with safety. He knew the opposite was often true. The most dangerous assets were those whose prices felt calm because they concealed fragility. The safest assets were sometimes those whose prices fluctuated wildly but whose fundamentals were strong. Risk lived not in price movement but in permanent loss of capital. During periods of optimism, Graham would grow cautious. During periods of despair, he would grow attentive. He did not attempt to time markets. He aligned himself with extremes of emotion. When everyone agreed something was safe, he assumed danger hid beneath consensus. When everyone agreed something was hopeless, he looked for overlooked value. Agreement inflated prices. Disagreement created opportunity. As years passed, he noticed fewer investors willing to read full reports. Fewer willing to calculate intrinsic value. More willing to outsource thinking to trends and forecasts. Forecasts comforted investors. They replaced uncertainty with narrative. But Graham had learned that forecasts fail quietly while discipline endures silently. He taught his students that investing was not about being right. It was about being less wrong than average. That humility outperformed confidence. That the goal was not to beat markets every year but to avoid catastrophic error over decades. Markets forgive missed opportunities. They do not forgive ruin. One student once asked him how to remain calm when prices collapse. Graham answered without hesitation. You must decide before the storm who you will be during it. Decisions made under pressure reveal preparation or lack of it. Calm is not personality. It is structure. Structure allows reason to function when emotion dominates. He encouraged his students to imagine owning businesses rather than symbols on screens. To care about cash flow, not applause. To accept that markets would mock them during periods of underperformance. He warned that patience would be tested precisely when it is most valuable. Those who endured would later appear wise. Those who abandoned process would appear unlucky. Luck was rarely the true cause. In private, Graham acknowledged that even discipline could not eliminate loss. Loss was inevitable. What mattered was scale. Small losses educated. Large losses destroyed. Margin of safety existed to limit damage, not to eliminate discomfort. Investing without discomfort was illusion. As retirement approached, Graham reduced activity. Not because opportunity vanished, but because his objectives changed. Preservation replaced accumulation. He understood that the hardest task was not growing wealth, but keeping it. Wealth exposed character. Some became reckless. Others became fearful. Very few became wiser. On his final visit to the office, Graham closed his notebook gently. He did not believe markets would remember him. He believed principles would. Markets change. Behavior repeats. Those willing to observe patiently would rediscover what he had learned. That investing was less about intelligence and more about temperament. Less about prediction and more about preparation. Less about excitement and more about endurance. Outside, the city continued its restless motion. Inside, the room remained still. Graham turned off the light and left, knowing the markets would open again tomorrow, offering prices shaped by emotion. He also knew value would remain quietly indifferent, waiting for those willing to listen rather than react. Those who understood this would not need to rush. Time would meet them halfway. And so the story continues, each generation encountering the same market wearing a different costume. Some will chase certainty and find fragility. Others will accept uncertainty and build resilience. The difference will not be intelligence. It will be patience. He would often say that the most dangerous moment for an investor arrives not during collapse but during recovery. Recovery restores confidence before discipline has been rebuilt. Prices rise faster than balance sheets heal. Narratives return before margins are safe to do. Graham watched this pattern repeat endlessly. Investors who survived the fall believed survival itself proved skill. They mistook endurance for invincibility. The market punished this confusion gently at first, then decisively. During one such recovery, Graham received letters from former students. They spoke of gains regained and losses forgotten. They asked whether it was time to be aggressive again. Graham responded cautiously. He reminded them that aggression is easiest when it is least rewarded. Opportunity emerges when patience feels uncomfortable, not when it feels justified. He urged them to examine valuations rather than emotions. To ask what had truly changed besides sentiment. He revisited companies he had once owned and others he had rejected. Some had grown into their valuations. Others had merely inflated. He saw how capital followed stories more eagerly than earnings. He saw how institutions rewarded short-term performance, encouraging managers to prioritize appearance over substance. This incentive structure concerned him deeply. Markets did not merely reflect behavior. They shaped it. Graham believed investors were shaped by the environments they survived. Those raised in abundance underestimated risk. Those raised in scarcity overestimated it. Wisdom required integrating both perspectives without being dominated by either. He encouraged investors to imagine scarcity during abundance and abundance during scarcity. This mental inversion protected against extremes. He recalled the early days when accounting standards were loose and disclosure minimal. Investors relied on trust more than transparency. Losses taught them skepticism. Over time, regulation improved disclosure but did not eliminate deception. Numbers could still mislead when interpreted without context. Graham emphasized understanding accounting not to catch fraud but to recognize illusion. Earnings could be engineered. Cash flow was harder to fake. One afternoon, he reviewed a company praised endlessly in financial press. Its growth was impressive. Its story compelling. Yet its balance sheet revealed heavy reliance on debt. Revenues grew but margins thinned. Capital expenditures consumed cash. The business required constant expansion to justify valuation. Graham recognized fragility disguised as success. He passed. Later the company faltered. Not because of scandal, but because expectations outran reality. This reinforced his belief that investment risk often hides within consensus admiration. When too many agree, price becomes disconnected from value. Dissent becomes costly socially before it becomes profitable financially. Graham accepted this cost. He did not seek validation. He sought alignment. As markets matured, Graham noticed investors increasingly delegated judgment to formulas and models. Models promised precision. Precision created confidence. Confidence invited leverage. Graham warned that models operate within assumptions. When assumptions break, models amplify error. Reality is not obliged to respect elegance. He taught that numbers must be interrogated, not worshipped. That intrinsic value was not a precise figure, but a range. That safety existed within that range, not at its edge. Investors who demanded exactness often positioned themselves dangerously close to error. In quiet moments, Graham reflected on how investing mirrored life. Those who planned for perfection struggled with disappointment. Those who planned for imperfection endured change. Resilience came from accepting limits rather than denying them. Markets rewarded this acceptance indirectly through survival. He remembered an investor ruined not by bad decision but by refusing to exit when evidence changed. Pride locked him into loss. Graham understood that ego was the most expensive asset an investor could carry. Letting go preserved capital. Holding on preserved identity. Markets punished identity. As years passed, Graham spent more time teaching than investing. Teaching clarified his thinking. Explaining principles exposed weaknesses. He refined ideas not to impress, but to simplify. Simplicity endured stress. Complexity collapsed under it. He reminded students that investment success was cumulative. Each correct decision mattered little. Each avoided disaster mattered enormously. Avoiding error compounded invisibly. Outsiders noticed only results, not restraint. They praised genius without seeing discipline. Graham emphasized that the goal was not to be right often, but to be wrong small. Wrong small allowed learning. Wrong large ended participation. This asymmetry defined strategy. He structured portfolios accordingly. Diversification was not ignorance. It was acknowledgement. He observed how new technologies changed execution but not psychology. Screens replaced paper. Speed replaced delay. Emotion remained constant. Faster markets compressed reaction time, increasing the cost of impulse. Structure became more important, not less. During one lecture, Graham paused and asked his audience why markets existed. Silence followed. He answered himself. Markets exist to allocate capital efficiently. Not to entertain. Not to validate opinions. When investors treat markets as games, allocation suffers. Value creation slows. Instability grows. He warned that excessive speculation diverted capital from productive use. When speculation dominated markets, productivity stagnated. Societies paid the cost through inequality and fragility. These were not moral observations but economic ones. Capital misallocation weakened systems. Graham believed long-term investors served a stabilizing function. They absorbed volatility. They funded durability. They reduced reliance on leverage. Their presence lowered systemic risk. When they retreated, markets became brittle. He worried that culture increasingly celebrated speed over endurance. He worried few investors would remain patient enough to anchor markets. Yet he believed incentives would eventually restore balance. Excess always created opportunity for restraint. In his final years, Graham watched markets with detached curiosity. He no longer felt compelled to act. He had seen enough cycles to recognize rhythm. He trusted principles more than prices. He accepted uncertainty without anxiety. He knew markets would outlive him. He knew his writings would be rediscovered during future crises. Investors would read them searching for reassurance. He hoped they would find discipline instead. On a quiet morning, Graham walked through a park watching leaves fall slowly. He smiled at the thought that markets behaved much the same. They rose and fell, shedding excess, accumulating value, repeating endlessly. Those who fought the cycle suffered. Those who adapted endured. He believed investing was not a battle against markets but a partnership with time. Time rewarded patience, punished impatience, and ignored excuses. Investors who respected time prospered quietly. As the sun lowered, Graham reflected that his greatest contribution was not formulas or strategies, but temperament. He taught investors to remain rational when emotion dominated, to remain humble when confidence surged, to remain patient when boredom tempted abandonment. He believed these traits mattered more than intelligence. Intelligence fluctuated. Temperament endured. The market would open again tomorrow. Prices would move. Stories would form. Fear and greed would alternate roles. Value would remain in different weighting. And somewhere another investor would stand at the edge of a decision believing this moment was unique. The lesson would be available quietly unchanged, waiting to be noticed. Those who listened would endure. Those who reacted would repeat the cycle.